Got 27 slides to go through, so I'll try to move along here. We're going to discuss lifetime income fixed annuities, lifetime income immediate annuities, deferred immediate annuities, and deferred fixed indexed annuities. And we're going to show how they stack up against one another. And then we are going to go into growth annuities. And then we're going to talk about the markets in general. So here is a chart that you're used to seeing. We've got large cap stocks, we've got long-term government bonds, and we've got treasury bills and inflation. So with large cap stocks, you've got a 10% historical return over the 90-year period, 1927 to 2016. This 20% is your volatility, also known as standard deviation. Your long-term government bonds, a 5.5% return with a 10% standard deviation and level of volatility. And then we have U.S. Treasury bills, 3.4% with a 3.1% level of volatility. So there's no question that if you could handle the risk, then equities are the way to go over the long haul, no question about it. But most of us can't. You can't, if you have $1 million portfolio, you can't take 5% off of that and sleep well at night because things happen. In a 30-day period or so last year, right now, 12 months ago, the S&P, which is the large cap stock here that they're referring to, was down 37% peak to trough. That is a huge drop. So most people need something to temper that in their portfolios. Historically, we've utilized bonds, but bonds are at all-time lows, and they're starting to come up. So we saw the bonds, the Treasury bottomed at 58 basis points last April. I think it was the 21st, and it's up to 147 today. That's a 156% increase in the interest rate. So if you put $100,000 into Treasuries at 58 basis points, which sounds atrocious unless you're looking at Germany, which is about a point lower than that. They're in negative about the same amount. But if you did, your 100 is probably worth about 85,000 right now. Yes, you're still receiving your 600 or your $580 a year in interest, but your principal, if you sold today, would probably be about $85,000 in value. So pretty horrific. Here we have the last 90 years again. 10% for large cap stocks, think S&P 500. Risk, 20%, that's your standard deviation, okay? Long-term government bonds, 551, half the risk, okay? So here's an interesting one here. Look at the last 10 years. This data, by the way, as they say in this business, the dates can make liars out of all of you. This is 2007 through 2016. Average return on the large cap stocks, 695. The risk again, 20%-ish, 19. Long-term bonds, 648, and risk 15.13. So the bonds almost returned as much as the stocks during that period. That's not from the yield. That is from yield plus the falling interest rates. And how much lower can they go? Well, we've seen them come up again, 156% from 58 basis points last year in April to right now, present day, 147 on the 10-year Treasury. Okie dokie. So let's see. This side is we've got large cap stocks. We've got, again, 90 years, 992 annualized return, 20% standard deviation. The minimum annualized 3-year return, 27%. This is why most people cannot handle being in a 100% equity portfolio during retirement. It makes perfect sense. The maximum was a 30% return. And long-term bonds, 532, half of the risk and volatility, but then you've got minus 2.32 as opposed to minus 27%. This is why people use bonds, but bond rates are at the lowest levels that they've ever been at, and we have the lowest levels that we've ever seen in mortgages, and actually they're starting to come up a little bit. I think they just crested 3% on a 30-year mortgage for the first time since last July. And you see that the return was also very good here, 23% over for the maximum annualized. FIA, this is the first time you're seeing the fixed indexed annuity mixed in here. This is from the Ibbotson report here, 581 compared to 532 for bonds. And they don't need a drop in rates to produce this yield. They've also have the same standard deviation, but you have a guaranteed return that you can't go backwards. I'll talk about this a little bit more in a few moments, but if the market goes down 20% and your million becomes 800,000, in order to go from 800 back to a million, and this is without taking any income, you have to go up 25%, okay? You don't have to dig out of a hole with an FIA. You buy the index with 100% of your money. In most cases, you're buying the index that didn't perform for you for the previous 1 to 2 or 3 years, as they use in here. You're buying it at a 20% discount with 100% of your money. That is profound. And then notice that there's a 0.00 risk over that 3-year period, as opposed to a 27% negative number over here for large cap equities, aka Standard & Poor's 500. Okay, so moving right along here. This is just showing us the bond average. We've got 1.87% is the, when you're looking at the below median bond returns, if you go back over the last 90 years and you took 3-year periods, there's 15 of those in 45 years, and there's that were underachievers, and the bonds averaged 1.87. The fixed indexed annuity averaged almost 2.5 times that amount. That is a huge difference. So if we get into an area where we have flat or rising interest rates, well, if we have flat, you're probably going to make, well, the 10-year treasury is at 147 right now. If rates rise, that 147 becomes less than 147. The only way it stays at 147 is if you hold that 10-year treasury for 10 years. And so here with the FIA, you're looking at 442. So that's a big difference. The next slide here shows the top of the screen's cut off for me because there's a bar up there, but I think it's 755 for the fixed indexed annuity and 9 for the bonds in the best period. And it actually might tell me that it does. Long-term government bonds, 9 in the high period, 755 for the FIA, 187 for government bonds, and 442 for the FIA in the low periods. And here's the overall returns, 543 for the bonds and 598 for the fixed indexed annuity. So, and with zero risk as compared to the S&P 500 with almost double the return, but exponentially more risk. And then down here, it shows that if you mix the stocks with FIAs, you actually do better than the bonds, 877 versus 855. This is going back again 90 years. That's when bonds actually yielded something. I mean, who remembers the Dreyfus Worldwide Dollar Fund that used to pay 8%? So when Peter Lynch used to say, a world famous manager of Fidelity Magellan, if you don't have 10 years to stay in the market, stay in the money market. Okay, so that's when money markets actually yielded something. Right now, they're yielding next to nothing. And okay, this is showing equity environments 3-year annualized return. It is showing what happens in a -10 market, in a 0 market, in a +10 market, in a +20 market. Well, equities are going to do just that because that's what it's showing us it did. Fixed income, these are your corporates or your govies, 1.8 across the board. The fixed indexed annuity, 0 in a down market versus -10, 0 in a flat market, and then in a +10 market, it's showing 3.7, and in a +20 market, it's showing 8.3. Again, they're using a generic uncapped strategy. In a moment here, I'm going to share with you a program that, once again, is anything but generic. It says up here, generic. Okay. This just explains and tells you that annuities have for a long time deserved a place in retirement portfolios. And I would encourage you to request this report. We'll get it out to you. You do need to request it, and we'd be happy to send it out. We're starting to get into the top recommendation, as I said, not just now, but possibly ever in terms of growth fixed indexed annuity. And you can see where fixed indexed annuities fit in to the risk reward scale. On this end, we have cash that pays nothing. Money markets accounts pay nothing. CDs pay 1-ish. Fixed annuities about 3. Fixed indexed annuities, and then we have bonds. So less risk, higher return than bonds, especially now, with interest rates as compressed as they are. If this was a spring, it would be completely compressed. It's come up a little bit. Now you can see between the coils, but that means there's a tremendous amount of risk, and that's what's making the market go crazy right now. You know, tech companies, anytime interest rates rise, that is going to send it spiraling. And if we're actually going to have our 3rd down week in NASDAQ. It's about to you know, well, it's not going to bounce back by today or tomorrow. So next slide here. This is a great, you know, picture tells 1,000 words type slide here. We've got you've got 1231.99 over here on the left. My annotation thing doesn't work, otherwise I'd be highlighting this right now. And what you're seeing is that the market went down. Remember 1999, remember the dot-com bubble, who could forget that? 2000, 2001, 2002, the NASDAQ was down over 70%, okay? S&P 500 well over 50 on a cumulative basis. And look what happened with the fixed indexed annuity. Here they're using the Fidelity multi-factor yield index. This is a part of the program that I'm going to share with you. Some of you may know it already. Some of you possibly already own it, hopefully through us at Somerset. But look what happens here. You've got the stair stepping because you're locking in your gains. You're never going backwards. You're increasing in value, up, 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 and up. And you can see where you're resetting and you're locking it in. And again, if the market is down, not only did you not lose, but you bought it at a discount. How great is that? There we go. Next slide. Here's the product. It's called the Midland National Retire 10 Advantage, or Retire 10 Vantage. Pardon me, Retire Vantage 10, excuse me. And this product is from a great company. I'll share with you the ratings down here, but the Comdex on it is an 89. Puts it in the top 11% of all insurance companies in this country. And very strong parent company, Salmons. And this is a product that a company I've worked with for maybe 3 decades. Here's an example of the funds that you can choose from, and hopefully you can see the cursor over here. The one that we like is this 2-year point-to-point. It's an uncapped strategy for both of these indexes, and it has enhanced participation because you're paying a fee. There's a 1% fee for being in these two indexes, and it's worth it because you can buy them without the participation or without the fee, and your participation rate is significantly lower. We'll talk about this on the next slide. But these are the two programs: the Standard & Poor's Mark V Index and the Fidelity Multi-Factor Yield Index 5% ER. You can pull these up. Just type it into the internet. It's going to come up, and you'll be able to track it daily if you so choose. This is an illustration. We're using John Smith again. We're using Florida. This program is available in most states with most of the options available, and with the exception of New York. Pretty much nothing, in my opinion, worthwhile and I don't even know if they have fixed index annuities in New York that are even worth talking about. But other than that, it's pretty much available everywhere. Okay, so here's the Fidelity MFY Multi-Factor Yield 5% ER, 2-year point-to-point is what this means. You can request an illustration from us. We'll have that run for you, lickety-split. 165% 2-year participation rate, 165. Index goes up 10, you get 16.5, and you have a 1% strategy fee. So, and I'm going to show you here in just a brief second here in the next couple of slides what you would have made over the last 2 years, taking a 2-year period for 2019 and 2020 to the end of last year. So 165 also for the S&P Mark V. Now, we split it 50-50 between these. Our allocation is a little bit more complex than that. And we're going to put half of the money in a 1 year, and it's only in the S&P 500, or pardon me, it's only in the S&P Mark V. And then after 12 months, when that 1-year bucket matures, we then split it up between these two funds, and then you have 50% of your money coming due every year. This is excellent for people to be able to take out income. If somebody needs income in the first year, we set that aside. In the 13th month, hopefully after we have some returns, to the best of my knowledge, just about every single year, you would have received a return out of at least one of these two programs. And the one that didn't have a return, you would have been buying it at a discount. So it's pretty fabulous. Half the money would come due every year. The reason for the 2-year participation rate, or for the 2-year point-to-point, is because you have a much higher participation rate. So here's some numbers. So this was, well, that was as of the 26th when I ran this, but let's take a peek at the December the 31st, 2018. So January 1st of 2019, it was at 314.41. And then 2 years later, it was at 387.10. So the difference between those two numbers is 72.69 between the first slide and this one, okay? So your gain was 72.69, expressed as a percentage of the starting number, that was 23.12. You multiply that by the 1.65, or the 165% participation, and then you back out the 2%, 1% per year for the strategy fee. The percentage gain was 23.12. But because you had 165%, even after the 1% fee deduction, and by the way, they don't take that fee and line their own coffers, and they certainly don't send it to us. What they do with it is they use it to buy more options. And if you're wondering, how can this be possible? How can you net 36.15% in an index over 2 years that only returned 23.12? And that's because they're buying options on the participating indexes. That's what they're doing. And this is what you would have made with zero risk, 36.15%. Divide that by 2, 1807.5. If my math is correct, that's incredible. Okay, compare that to a 1% CD or a 3% fixed annuity, and I'll take this product all day long. It gives you, there's no greater hedge against inflation than the stock market. There isn't. Yeah. Real estate second, and it's the other asset class that's not in here. You have stocks, you have bonds, you have cash, you have real estate. That's pretty much what you have, period. That's what we have to invest in. We have a couple of non-correlating investments at Somerset that we're also happy to share with you, but that's primarily it: stocks, bonds, cash, real estate, and this is a way to beat the bonds, especially now with rates as compressed as they are. Let's take a peek at the Fidelity. Here is the multi-factor yield. Here's the starting number, 239 spot 49. Call it January 1, 2019. 2 years later, it's 279.54. Okay, and the difference between those two numbers is it's a 40.05% gain. The percentage gain is 16.72. You multiply it by 165%, that's 27.59. You back out 2% for the strategy fee. It's not a fee on the contract, it's a fee on the strategy, and you want it because it's turbocharging. It's like more expensive fuel for your race car. And you've got a net of 25.59 divided in half is 12.80, 12.8% without any risk, no market risk, and next to zero credit risk. All of these annuities, fixed index annuities, they're part of the general accounts of the insurance company, which means that they're not sold by prospectus. They're guaranteed return annuities, and they're backed by the underlying claims paying ability of the insurance companies. You're probably, if you're familiar with annuities, you're familiar that with the fact that there is a state guarantee fund for all 50 states and the 3 territories, so 53 departments of insurance. And we don't present that part of it. We go off of the safety of the companies. And again, this is one of the safest insurance companies in the nation. And to date, to the best of my knowledge, which is 31 years of industry experience, nobody's ever lost any money within the general accounts of any insurance company. And that goes back a long, long time, you know, certainly close to 200 years. And that's why it's one of the 2 true guarantees in this country. And I'm not talking death and taxes, of course, it's that as well, but it's also the federal government and government agency obligations like FDIC and Fannie, Freddie, Ginnie, all of those, and then you have the underlying claims paying ability of our federal government and the great printing press that we keep printing more money. That's figurative, but it's in the computer and they're keeping track of it, and we're printing a lot of it. And then we have insurance companies. So we can use the term guarantee. If anybody else is using the term guarantee with something, it's your friend that's guaranteeing you something. But companies can't guarantee you anything other than the insurance companies with their general accounts and the federal government. So 12.8%, again, no risk, no market risk. If the market went down, you would have been buying this index at a discount. Okay, this is an illustration. This shows those 2 indexes, 50-50 allocated. Now, the way we do it, we're going to put half of it in the 1 year, and then we're going to immediately switch it into splitting it between the 2 2-year options. So you won't see these zeros. This is, you may be up big here, but it's not showing it because you didn't register those gains until the end of the 2nd year. So the most recent 10-year period, 783. How about that? 8% in a 3% market on fixed indexed annuities and, pardon me, on MYGAs, multi-year guaranteed annuities, and MYGAs pay more than CDs, well above CDs. This is exponentially more than both of them. The highest number is very high, it's double digits, but my favorite number is this lowest number, 617. That's 2x fixed annuities. That's above bonds, certainly now. How are you going to get 617 in a bond? How? You can't do it with an investment grade bond. No way, no how. It's not going to happen. And when rates rise, you're going to see a lower number. You better be young enough to hold it to maturity, and and if you want appreciation, if it was going to drop, it has to be non-callable. So otherwise, they get you coming and going. And so 617 to blend in with your equity portfolio, that's phenomenal. It's incredibly hard to beat the S&P 500, incredibly hard. Any mutual fund manager will tell you it's incredibly hard. My neighbor used to manage a giant fund for Columbia funds. And if the market was down, it didn't matter. I would ask him what kind of a day he had, and he said, it was a good day. And the reason he would say it was a good day if the market was down, that means he beat the S&P 500, okay? So programs like this combined with the S&P 500, by the way, we have a program that we'll also be happy to share with you that will guarantee you 130% of the S&P 500 minus a 95 basis point, that's 0.95% fee based on the original premium. It registers the market daily on your account, and it doesn't pay dividends. But dividends on the S&P 500 right now are about 1.5%. They're not very high at all. And they're low for a couple of reasons. One, the market's at an all-time high, okay? And trying to be able to take income off of the market and sleep well at night, good luck. I mean, that's like trying to get a good night's sleep in a washing machine. You can't do it. You need something that's stable. You can't be selling your shares when the market goes down to provide for your income. You'd be selling more shares at a lower share price. We also have a great piece on that. It's called the sequence of returns versus the average returns. It's the sequence of returns when you're taking income, okay? So you need something that's safe that you can take your income from. And the fixed index, and that's usually bonds, but now it's fixed indexed annuities. And we're super excited to mix them in with our portfolio. And then again, back to the program that returns 130% of the S&P 500 with no dividends, it still beats the S&P 500 because it's 130% of the S&P 500 minus the 0.95%, and that 0.95 is based on only the original premium. So it's outperforming the S&P 500 by 5%, maybe a little bit more on the upside. But guess what? It also has protection on the downside to the tune of 20%. This is 100% downside protection. The other product that I'm touching on now that I didn't necessarily plan on going into has 20% downside protection, and it's a 6-year program. And guess what? There hasn't been a period where the market lost more than 20% over 6 years, going back over 12,000 6-year closing periods, going back 40 years and crawling through every daily close after you take the first 6-year close. So I know that that's a lot to try to comprehend, but if you complemented or if you used this program to complement your portfolio with managed money or the S&P 500 and threw in some of this other product, you'd be in pretty good shape. Maybe throw in some real estate and a couple of other things, and you'd have an incredible portfolio. This is the safety. You can see their ratings, great ratings, and this is through Comdex. This report is also available to you. If you would like it, we can give you every insurance company that has a Comdex rating. They're compiling all of the rating services, AM Best, Standard & Poor's, Moody's, Fitch, and they come up with a score, a number score here. Here's the information that we covered today. Please contact us and for any of this information, and for that additional information I mentioned on the other product. By the way, that other product is not a fixed annuity. It is a variable annuity because it only gives you 20% downside protection, not 100% downside protection. And appreciate everybody coming on the call or on the webinar. I'm really sorry for the technical difficulties. Next time it'll be a lot better and smoother as long as my computer doesn't lock up. And have a great day today. And thanks for joining. And we'll talk to you soon. Thank you so much.